Thank you for watching module number 5. We're going to talk about income-driven repayment plans known as IDRs and how they work. Now, as hopefully you know by now from earlier modules, there are a lot of individual repayment plans on your federal direct loans, but they all fall into one of two categories. The repayment's either based on a time period called time-driven, or the repayment plan is based on income called income-driven, and that's what we're going to talk about in this module. Now try and keep this as simple as possible. An income-driven repayment plan is simply designed for somebody who can't afford repayment under a time-driven plan like the standard 10-year plan. And an easy way to think about it is the bigger the gap between the federal debt, the federal direct loan debt that you have and your income, the more likely you are going to need an income plan unless you've got some other resources to help you pay down your student loan debt. The monthly payments are calculated on a federal formula that looks at income and family size, and the income is based on income from a prior year tax return. Now, unlike payments with a time-driven repayment plan, the payments with an income-driven repayment plan change every year. Once they're calculated, they're good for 12 months, but you have to renew these on an annual basis, and we would strongly encourage you not to miss the renewal deadline. If you miss the deadline, your payment will dramatically increase and interest is likely to be capitalized on your student loan debt. So the payments are good for 12 months. Your loan servicer should give you ample heads up that it's time to renew. They normally will contact you anywhere from 30 to 60 to 90 days before the 12-month period is up. So once again, the payments are good for 12 months, but folks, they change every year. Now, with an income-driven repayment plan, if you don't get the debt retired or paid in full by the end of the term, the debt is forgiven. This has nothing to do with public service loan forgiveness. This is called term forgiveness. You get to the end of the term, 20 years with pay, 20 years with repay for undergraduates, 25 years for repay for graduate and professional students. If you get to the end of the term and you still haven't paid the debt off, the government will forgive it, but the forgiveness amount has to be claimed that year as taxable income. Once again, we refer to this as term forgiveness. Now, you may hear the phrase IBR or the name IBR. IBR, income-based repayment, is a much older income-driven repayment plan. The more popular plans now for recent graduates are pay-as-you-earn, known as pay, and revised pay-as-you-earn, known as repay, and we have a separate module on pay and repay to help you make a decision about which is the best plan for you. Now, the clear advantages to an income plan is that they provide manageable monthly payments. That's why people use them. Again, if you can't afford a time-driven plan, look at an income plan. And once again, the use of an income plan may lead to forgiveness, either through the Public Service Loan Forgiveness Program. We'd encourage you to watch the separate module on public service loan forgiveness, or as we mentioned on the previous slide, it may lead to forgiveness at the end of the term if you have not retired your debt. But there's some potential disadvantages to using an income plan. The balance will grow on your debt if the payment under your income plan does not cover the interest that you owe each month. Common sense says that your debt is not going to start to go down until you cover more than the outstanding interest that's due. And if you have a big gap between what you've borrowed and what your income is, then the interest payments alone may be higher than the calculated payment you have with an income plan. And once again, that causes your balance to grow. That's why some borrowers who use income plans will end up at the end of the term and still owe. As we said earlier, you have to renew annually. That's not necessarily a disadvantage, but you do have to remember to do that. And the payments will increase dramatically and interest will capitalize if you miss that renewal deadline. And once again, a disadvantage to the use of an income-driven repayment plan is that if you don't retire the debt by the end of the term, you will be taxed on it, and that's not the case with the forgiveness amount under public service loan forgiveness. So advantages and disadvantages to the use of income-driven repayment plans. Now, if you understand this particular slide, we think you will really have a solid understanding of how income-driven repayment plans work, regardless of the plan you're using, pay or repay. And once again, we have a separate module on those. Once you get into an income-driven repayment plan, one of three things is going to happen. Your debt is either going to be forgiven after 10 years worth of payments through the Public Service Loan Forgiveness Program if you are working for a public nonprofit employer. That's the first thing that could happen. And if you have your debt forgiven after 10 years worth of payments, you'll never make it to the end of the term because your debt will be forgiven in 10 years. That's the first thing that could happen. The second thing that could happen is that you're not working in the public sector, and so you're not going to qualify for public service loan forgiveness, and you simply retire the debt yourself before the end of the term. Another way you could retire it is to not necessarily pay the debt in full, but to refinance it with a private lender. In other words, move it from federal debt to private debt. But the third thing that could happen, we've already referenced. If you use an income-driven repayment plan and the debt is not forgiven after 10 years of payments with public service loan forgiveness, and you cannot retire the debt yourself by the end of the term, at the end of the term, the debt will be forgiven, once again called term forgiveness, but you have to claim that forgiveness amount that year as taxable income. Now, the payments with the income-driven repayment plans, regardless of which plan you choose, they're based on income and family size. And once again, we mentioned this earlier, the income that is used is from a prior year tax return, unless your current income has decreased significantly from what you made last year. The Department of Education wants to help borrowers whose tax return in a prior year has income that is really not indicative of what you are currently making. So once again, the income that is used in the calculation is from a prior year tax return unless your current income has decreased significantly. Note that spousal income is counted under all income plans when you're filing jointly, and the only way to exclude spousal income from the calculation of payments with an income plan is to file a separate return and use pay as you earn, known as pay. We'd encourage you to watch the module on married borrowers if you're either married or considering getting married and have questions about how spousal income impacts these payments. Now, some quick takeaways as we close up this module on income-driven repayment plans. Once again, IDRs provide manageable payments. They work the way they're supposed to. The payments are based on income and family size. If you can't afford a payment with a time-driven repayment plan, take a look at an income-driven repayment plan like Pay or Repay. The payments change every year. Another reminder, don't miss the renewal deadline. Work with your loan servicer when your loans come due to actually apply for an income plan. We'd encourage you to contact them before you apply, but the application is actually online at studentaid.gov. One reminder, or one hint, if you will, do not let the loan servicer choose your plan. There's actually a box or a space that you can check that says, let the loan servicer choose the best plan for me. We'd encourage you not to do that. Do your homework and you make the selection of the income-driven repayment plan that you want. And you can switch plans if needed. You could, for example, start with revised pay-as-you-earn, known as Repay, and then later on move to pay-as-you-earn if needed. We'd encourage you to watch the module on Pay versus Repay to help. We hope the information in this module on income-driven repayment plans has been helpful to you. This is the end of module number 5. If you have questions about your student loans or financial aid, please contact the Penn Student Financial Services Office. If you have questions about general money management, please contact Financial Wellness at Penn.